that kind of stimulus, if we do get it, what does it need to be spent on, in your view, and how does it move the needle?
Yeah.
We're talking $137 billion or thereabouts, that's the reported figure.
I think a lot of that is going to be, like Bloomberg reported, is going to be addressing a lot of the helping to solve some of the local government debt issues, as well as infrastructure spending. That's going to help in terms of shoring up some of the demands that we've seen in terms of sentiment really struggling as we enter this post-COVID recovery phase. So I think, even though we haven't got, concrete details out of this potential package yet, I think the message is clear in the sense that the central bank and the government is still on that easing path to really, one, to acknowledge that recovery hasn't been as positive as they would have hoped. And the other part is they are definitely still hoping to do more in terms of helping to shore up the overall recovery.
I'm curious what the appetite has been from your clients' conversations on just increasing their exposure to China.
Yeah, I mean, on one hand, you still have that, lingering impact from the sentiment recovery where, things haven't gone back to pre-COVID levels in terms of the confidence side of things. But you definitely still hear more in terms of the overall growth story, even though it's, not as positive as it's been for the past 2 decades. Definitely is still a positive out of China in the longer term, given that they have been prudent in a way that they want to balance the short-term gains versus longer-term adjustments that needs to be made. And also, given China's outsized impact on EM in general, once we, exit this current higher for longer rate period, we still have to look for yield somewhere. And China and the overall EM space is definitely the place to go.
But the U.S., you're still thinking, could outperform?
Of course.
Even at this point?
Even at this point. I mean, there is still that, quote-unquote, American exceptionalism story that's currently happening. We do have the dollar that's going strong still. And, of course, with everything that's happening in the Middle East, that's going to drive a certain level of safe haven demand. And that's actually happening before this current event that's unfolding. Investors have been a little bit on the fences in terms of their holdings. They have been trying to reduce their risk exposure, given that this higher for longer rates period. So, there's definitely some cautiousness in overall asset allocation space that we've seen.
Overweight Treasuries. Now, I just want to ask you, at these sort of levels, so you think we topped out with yields, in other words? I
mean, if not, we're definitely close, given that if the Fed, whatever they do in November or December this year, we are pretty much close to peak if we're not there already. So at the current levels, given how much adjustment there has been on the Treasury, it definitely looks attractive to us. And again, we do have this, period of a lot of uncertainties in terms of geopolitical events. That's going to drive a lot of the haven demands as well.